The opening range breakout, the definition of simple trading. But does it really work? I'll show you. I backtested 5 years of it, so I'm not just sitting here yapping, hating on a strategy. I did the work, I coded it, and I'll show you a bunch of data, if you're interested, of course, on why it doesn't work. Basically, it gets in too much drawdown, and the markets don't trend enough for it to work out long term. So what did I do? Well, I took 5 years of MES futures data from NinjaTrader, and I coded up a script. Let me show you what the script did. Right here. This is a brief summary of everything that the script does, the rules, how it trades. If you don't know what opening range breakout is, you wait for the New York Open, 9:30 Eastern time to 9:45. That whole 15-minute range is your opening range. So if a candle closes above or below, you just follow that direction. So close above, get in longs, stop at the other side of the range. Super simple. What a dream it would be to trade such an easy strategy, right? I mean, I did it, a variation of this. I was on the 5-minute. I waited, tried to get out of some manipulation, but it tanked my account to minus 90% if you saw that video. Anyway, this isn't about me. This is about the strategy. So opening range, and there's different options for that candle close I mentioned. So I swept through 1, 2, 3, 4, and 5-minute because I didn't want someone telling me, you used the 1-minute close. If you used the 5-minute, it would have worked out. So I did it all. Why not? The risk to reward, also swept that. Target something small, like half of the risk, all the way up to 6. So you catch all those big moves. No closing early, no trailing stop, no nothing, okay? So we have a lot of sweeps in here. Also, the risk per trade, because I want real data. I don't want to do no averaging back test like you saw me before, make that mistake. So now I'm doing real testing. Some of the trades, one of the sweeps will be 1%, then one of the sweeps will be 2%. You'll understand what I mean by sweeps. And the rest of the rules here. One thing, the only filtering I did on days that I didn't want to take the trade is when the opening range was just too much. So that's like a 60-day average of what the range is, and then 2 standard deviations around that are the trades I took. If you don't know what standard deviation is, this isn't a stats video, so you could go look it up. But it's basically taking most of the range sizes on the average of the 60 days. And if the range is too big or too small, we didn't take that trade. Simple as that. And every 60 days previous, that would be the average. So in 2025, we're not looking at 2022 ranges, right? We're looking at 60 days before today. And I think that's enough yapping on what it does. So we got this code here. I could send this to anyone, but I don't think anyone's going to be interested, right? It's real long. I'm not going to go through, obviously. This is not a coding channel, but yeah, the magic it does is what's important. What do we get out of this, right? We get this. Yup. I know. You don't want to see this. Your head is already hurting. But all you need to see, look, January 4th, 2021. Why are there so many trades? This is the trades file, okay? This is all the trades that the script took because of our sweeps. So this first row, it took it at a 0.5 R and on the 1-minute candle close, okay? And then it swept through all the Rs, all the 2-minute, 3-minute, 4-minute. So it's giving you all your options, right? Then the next day, same thing. You're going through all the RRs, all the time frames, okay? And this is all 5 years, baby. 2021, 2022. This is all 5 years, okay? How many lines is this? 65,000 lines. We're not going through line by line. But from that, we can generate another spreadsheet. Let me expand this for you so you could read if you're interested. Now this is one specific sweep. So up here, the title, you can see 2.5 risk to reward, risk 1%, and time frame 2. So we're waiting for 2-minute candle closes outside the range. We're taking 2.5 risk to reward, and we're risking 1% per trade. And this just goes on. You see equity after. So we start the accounts at 10,000 and we go all the way down. I'm going to show you the actual results, but we end up at 20,000. So somewhat decent returns. We'll talk about that some more. But right now, going through all the data we have. And this is the summary. So that thing you just saw was one sweep, right? Now this is showing all the sweeps. So that one sweep I showed you was the 1% here, which is hidden down here somewhere. So you see this row, 2.5 risk to reward 0.1 ended at 20,000. So this one row is all those trades you saw on the last spreadsheet, summarized line by line. So from this, we can see which one did the best. So that one case I showed you, it was only 1% risk, but up here we got 5% risk. We end at 86,000 net profit. Don't get excited yet. Hold on. I'm just showing you 3R. You see, this is why I selected 2.5R, 3R, 4R, 3R, 4, 1.5. None of them do as good. Okay, the profit at the end is not as good. $250,000 drawdown? Oh my goodness, that is not good. That is not good. I'm not sure. Whoa, that's a lot of drawdown. Anyway, we're looking at the best of the best, okay? 2.5R, 5% risk, but that's insane, and I'll show you why. We go to something more visually pleasing, okay? First, the 1%. So this is the same thing. We'll zoom out a little bit, zoom out just a little bit here so you can see. 10,000 to 20,000, as we saw the 2.5 RR, 1% risk, 2-minute time frame close for the entries. The orange here is FXAIX, real data I downloaded the last 5 years, which is the S&P 500 with dividends included. So this is like the baseline you're looking to beat, because everyone says you're never going to beat the markets, invest, blah, blah, blah. Just sit on it. And so this blue line is the orb, the opening range breakout strategy. And you see it looks not too bad. This is somewhat manageable of a strategy, but it depends on how you see it, because I'm looking at this like it's awful because of two reasons that I mentioned in the short, but I'll mention it again. From 2023, you see here, 2023 to basically 2025, you make barely any money. You're sitting on this strategy for 2 whole years, making no money. That wasn't an option for me. Another thing is 20% drawdown on a 1% risk is not ideal at all. You see here, you go almost a full year of losing money. So depends on your goals, of course. If you're planning on managing money, you don't really want to go in 20% drawdown, maybe 10% worst case. So you should be risking less and less as you go more in drawdown, which will take longer to recover the account. And with a strategy like this, I don't think you'll ever recover the account because you're counting on these big spikes here. You see this? This is a nice streak of winning here. Maybe 10 winning days in a row with 1 or 2 losses. That's basically what this strategy relies on. And then you sit through chop and chop and chop. So I don't think it works. You can argue against it. Sure, you beat the market, but I don't think it's a good strategy. Could it be improved on? I think so. But now let's risk more. We're only risking 1% here. Nobody actually does that, especially small accounts, right? If you only have $1,000 or $4,000 like me, you want to risk more. So, before that, let's go to the 5% risk. This was the top of our summary on the spreadsheet I showed you. This was the best producer, the final value with the most amount of money. We end with $96,000. So 10,000. 5 years later, we have almost 100,000. This number right here is 60% average returns per year. Average returns. Because 21 to 23, it was on some crazy stuff that, and from here, 2025. But why is this bad? Drawdown, 82%. You're at 125K up here. You go down, or even up here, you're at 125K. You go down 3/4 of the year later, you're at 50K. That's like 60% drawdown. You go back up, and boom, you get smacked again. You're 80% drawdown. You lost 100K here. This is not including any withdrawals from the account. If you wanted to pay yourself, or if you were managing it from someone and they wanted some money for whatever reason, quarterly tax payments, you're down at 25K, 80% drawdown. And for this to recover, these are those jumps I'm saying the strategy relies on. You have these small sprees where you just go crazy. If you could limit it and only trade during this time, but I don't know. I don't think it's possible, but maybe I'm clueless. Maybe I am clueless. I think this is not a good strategy. I mean, do I need to expand on it more? But let's risk a little bit less, because 5% is pretty crazy. Risk 3%. But it's about the same story. You get 60% drawdown, which is not great at all. You're losing way too much in a row. So we don't need to expand on this anymore. That's basically my biggest reason why I don't like this strategy. It just doesn't work consistently enough. Oh, but you get an 80% win rate. Okay, at what? 0.5 R and you never make your money back? It's just not ideal. And that's all the data I got. I think if you want more details, feel free. Join the Discord, and I can send you even the code file if you want, or these spreadsheets if you want to dive into it. But that's all I got. I hope you learned something. If you got something else you want me to backtest or maybe improve on this, I'm going to try to backtest some SMC, ICT stuff, like I said. So stay tuned for that. Hopefully I'll get some time soon and not hold you guys up for multiple months on a promise. But hopefully you learned something. See you in the next one.